Hi everyone, this is Rochelle Newson from Angle Invokers, Vancouver Island North. Today I'm here with Mackenzie Gartside from Mackenzie Gartside and Associates, and we're going to talk about mortgages. So Mackenzie, recently alternative lending options have become super popular. I'm wondering if you can explain what a mortgage is and what the difference is between a mortgage broker and working with someone, say, from a traditional bank.
For sure. So the reason that alternative lending is more popular in our area now is due to the fact that our population has bloomed. So more lenders are willing to lend out here, and there was more liquidity of funds during the pandemic. So the lenders were really creative. They came up with better product variety, which meant that it was more accommodating to a lot of borrowing situations, coupled with government regulation being tighter most recently. It just made sense for them to widen their landscape where they're lending. So in terms of what we can do versus banks is we have access to like 45, 55 lenders. So we have more product variety. So if you go to your bank and they have their 5 products and none of them fit, they can farm them out to a brokerage, and they generally will. You still end up with an RBC or TD or BMO mortgage. But at the end of the day, you're not really certain on how that process came together and if that product was the best product for you. Whereas when you see a broker, we're in depth talking about specific lending options, and we've investigated all of the possible lenders, and we're able to customize as best as possible that product to your needs, which might result in lower fees or a lower interest rate.
Okay, amazing. So you get more variety, potentially lower interest rates, and as far as like an experience goes, is it, obviously it's more customized to you, but service wise, is there a difference?
We definitely attempt that, of course. There's a lot of documentation involved with alternative lending. Lenders aren't following the standard lending practices, so they tend to want to comfort their investors with an extra level of scrutiny on those documents. So there's a lot of documents required, but at least we're able to handhold the client through that process.
Right. Cool. Thanks for that. That's really interesting. What are some of the more popular mortgage types, and how do you know which one is right for you? I feel like that's a pretty loaded question, but
it is a loaded question. So there are several different types, but it really breaks down to 3 main categories. There's conventional lending, and that's generally when someone's refinancing to take equity out of their property, or if they're buying with greater than 20% down. And then there's insured lending, which is less than 20% down, and you're purchasing only. It's not for first-time home buyers. Anyone can have an insured mortgage. The third type is insurable lending, and that insurable lending is kind of a subcategory that the government created in 2016 when they came out with the new mortgage regulations pertaining to the stress test. So you get a better rate with insurable lending, and determining what category or what a client needs all comes down generally to their down payment and credit. So if they have a down payment larger than 20% and their credit's fabulous, we'll generally go with the conventional or insurable option for the client, depending on what they need and the flexibility that's required. If the client has not such great credit, as long as they have greater than 20% down, we can usually fit them with one of those B lenders, or we can look at some private lending options, which is even higher rates and fees, but it does allow clients to get into those either quirky property types or just get them into a more feasible financial situation for themselves.
Right. So basically, you need to work with your experts on this to make it all happen.
Totally. Our most popular product is it's a step mortgage through Scotiabank. We do a lot of lending through Scotiabank. And that step product allows the client to have a mortgage and a home equity line of credit as they pay down that mortgage, and there's lots of flexibility on prepayment. Their home equity line of credit increases. So they always have access to their full borrowing capacity.
So if they wanted to do a renovation or maybe get into a secondary property.
That's right.
Amazing.
Yeah.
That's awesome.
Yeah, that's good.
What is pre-approval and why is it important? Realtors love this.
Yeah. So we don't like to do pre-approvals because there's some legal liability associated with that.
Okay.
So in the industry, we've changed it to pre-qualification.
Okay. Should I ask the question again?
It's all good. So pre-qualification generally means that we have taken a client's application, we've reviewed their credit, and we've reviewed their income profile, like looked at their documentation, made sure that the income that they state that they're making is actually the income that they're making. And then we say, barring that the property is kind of a standardized property, a city lot, those type of things, you should have no problem seeking approval.
Right. Should. Keyword.
There are potential issues. Disclosing information to your mortgage broker is so important. By not disclosing information, inevitably we're going to run into some hiccups. So if you had past credit issues that you were hoping wouldn't come up, those can come up. If we've issued a pre-qualification, then we get into the file, submit the file to a lender that you've had a past credit issue with. That could rear its head, and then all of a sudden now we're facing issues. So pre-qualification will smooth out your home buying process. Certainly, there's definitely some documentation required. It's not just 10 minutes on the phone.
Of course.
10 minutes on the phone is going to get you your approximate price range is this, but pre-qualification will allow you to house hunt more confidently. And a lot of times with the pre-qualification, if you call us, once you find a house that you're relatively interested in, we can tell you whether or not that property is mortgageable, because that property is a huge part of determining whether or not you'll be able to seek a reasonable and affordable mortgage on that property.
Right. So it helps smooth out the process, and additionally would probably give you an idea of your budget too, which is, that's kind of nice.
Yes, you have to know how much you can spend, for sure. Yes.
Awesome. I like that. Pre-qualification. Okay, well, you heard it here first. Mackenzie Gartside.
No pre-approval. Apparently it's bad.
I think the word pre-approval, it's like, oh, check mark, I've been approved.
That's right.
So I understand how that's misleading. Whereas pre-qualified, there's more steps beyond that. That makes sense.
Yes. And if you don't want to go through the whole credit check and income verification, often we can just do a rate hold, which will just secure a rate. We'll give you a general price range that you can potentially qualify for. And that will give you some sense, but it doesn't involve anything in depth. So you're not committed at that point, either financially or just with a hit to your credit, which of course can be detrimental.
Right. And how long generally is a rate hold valid for?
Some lenders is 90 days, but most are 120 to 180.
Okay. And are there ever any circumstances where they would extend it?
Yeah.
If you were kind of getting close?
If you're getting close and then you put an offer on a house, and let's say your rate hold expires January 31st, but your closing date's not till February 14th, a lot of times lenders will be accommodating. When interest rates are skyrocketing, it can be really it can be more difficult, of course. But generally, lenders try to be accommodating. Yes, they've done the work. We've done the work. Everyone wants your deal to come together.
Yeah, we're all working towards the same common goal. Let's make it happen.
Exactly.
Cool. So when you're on the home buying journey, when should you start thinking about the pre-qualification process?
So right at the start,
yes,
because you have to know how much you're house hunting for. That can be frustrating for everyone involved if you're looking at houses beyond your means. We want to set those expectations up right at the start so that nobody is being disappointed at the end of the day. So if you call us first before even reaching out to your realtor, we can give you some preliminary numbers and a bit of the process, just so that you feel much more comfortable proceeding before you're investing another third party's time. We do have a guide that has 27 steps called the Home Buyer's Journey that walks you through the process in a very detailed manner. And that pertains to the mortgage process, of course. But in general, I think it's very helpful for our client to know where they are on that journey. Because it's a journey.
Yeah, it is a journey. We'll put a link to that download. Is it like a PDF? Or?
I can upload it to the website. Yeah, it's a PDF.
Okay, awesome. Yeah, we'll put a link to that in the notes so that all of our viewers can take a look at that. I'm sure that it is pure gold. What are some of the main obstacles you see when home buyers are trying to get pre-qualified? And do you have any tips for getting organized in advance?
So again, it comes back to that documentation.
Right.
It's always documentation. So if you can reach out to your accountant and have your tax returns handy, or even just let your accountant know that we're going to be reaching out for certain pieces of documentation.
Right.
If you're self-employed, we need so much. If you're salaried, I can get away with just a pay stub in some instances.
Okay.
But having a better sense of where your income is from a calculable amount is really important, because a lot of people come in, I make 80,000.
Right.
And then I give them a pre-approval amount and it comes back that they make 77. It might not sound like a big deal, but on my end of things, if the property you fall in love with has property taxes that are a little bit more expensive, or my heat calculation's a little high, it might vastly affect your interest rate, or just mean that you're completely disqualified.
Right.
So it's really important for us to get that income piece correct right off the hop.
Okay, got it. That's a really good pointer. So that actually, I have two follow-up questions to that.
Sure.
So just on the topic of self-employed people, it seems like it's much more difficult to get pre-qualified or get a mortgage if you are self-employed. Why is that? And what are some things that all of our entrepreneurs out there can take steps to kind of, get the process moving?
Yeah. So in terms of lending, the self-employment process is pretty straightforward.
Okay.
We need 2 years of self-employment. It doesn't mean you have to have been self-employed for 2 years, but it does mean that I need 2 tax years reporting on your personal income taxes.
2 tax years.
And your taxes need to be filed.
Okay.
And you need to pay any taxes owing. So all those things are important.
Filed and paid people.
Yeah, exactly. And we average that income. So if your income was 40,000 one year and 80,000 the next year, we're going to average that. So you're going to have $60,000 of income that we're going to be working with.
Okay.
Okay. So if your income is increasing year after year, which we hope as self-employed people, then great. But if your income is declining, the lenders will actually be conservative and they will take the most recent year and use that. So if you were making 2020, you made 60, 2022, you made 40.
Right.
Unfortunately, that lender is going to look at that $40,000. So again, setting your expectations.
Right.
And if we're involved and you're planning your house hunting journey really early in the process, we can actually give you some direction when you're filing your taxes.
Okay.
And maybe you want to be a little less aggressive with your write-offs, and that way you'll have more income, which will help you qualify for more mortgage dollars.
Right. Okay.
In terms of B lending, we have some really amazing programs and lenders that we work with rates that are not that much higher than bank rates.
Amazing.
And you only need to be self-employed for 6 months.
What?
So I take your
Breaking news, people.
Yeah, even realtors with like a really good 6 months.
Yeah.
So we take your 6 months bank statements and we subtract the hard costs, and that's your income. We divide it by, we multiply it by 2, obviously. So if you made, you had $50,000 in regular deposits into your bank account, $10,000 of expenses, that's 40 times 2. Now we have $80,000 to work with.
Wow.
And in a lot of instances, it will make more sense to do that rather than try to go with the bank mortgage, because if you're writing down your income aggressively in order to not pay as much income tax, it's much cheaper to pay a higher mortgage rate than it is to pay a huge amount of income tax.
Okay.
So most people will go with the B route. So we do try to, educate clients, because B mortgages sound really scary. They're not scary.
Right.
They're slightly higher rate, and there's always a 1% fee.
Okay.
So $700,000 mortgage, an additional $7,000 fee.
Okay. Okay. So we've got options out there for our hardworking entrepreneurs. That's
Definitely.
amazing.
Yes. And those are all quite recent, the B options anyways. Lenders have only really started to accommodate that, I would say, in the past 3 or 4 years.
Okay. So interesting. Yeah, that's very cool. Could you explain what a credit score is and why it's important?
Yeah, for sure. So your credit score is a numerical value associated with your credit repayment.
Okay.
So as simple or as ridiculous as that sounds, there's basically 5 factors that go into determining your credit score. Let's see if I can remember them all.
Okay.
So credit repayment.
Credit repayment.
New credit, so that'd be credit checks.
Okay.
Okay. Credit volume, so how often you're, like what your balances are in relation to your limits. And even if you had, $50,000 of credit available to you. And if you're only using 10,000, great. But if you're up at that 50,000, lenders are going to look at your capacity and say, ooh, you might be really running it close.
Right.
Age of your credit, this credit mix. You want to have a mix of credit cards and loans. It doesn't mean that you have to have credit cards and loans necessarily, but it definitely does help your credit score.
Okay. So what are a few tips, you kind of just said one there that can help people better their credit, and additionally, what are some things to avoid?
For sure. So your credit has to be a certain level in order to qualify for a mortgage, especially a mortgage. Most lenders want to see your credit score above 600. If you're looking at insured options, above 650 or above 680. So it is really important to know where your credit stands. So one of my biggest tips is to refer you to a credit checking site like Borrowell, Credit Karma, Mogo, all of those ones. But one thing I would suggest is don't fall in love with your credit score on there. If it tells you you're 700, I could very well pull a credit score that's 600.
Right.
Because their credit scores, unfortunately, do not factor in your cell phone. And our credit scores factor in your cell phone. So
gotta have the cell phone.
Yeah, and if you don't pay your cell phone on time, which is pretty normal for people, you're going to end up in a lot of trouble when it comes to your mortgage application.
Pre-authorized payments, people.
Yes, yeah. And there's some other things that factor in. So we pull an in-depth score of 9. Those pull a risk score of 2. So there are some other factors, but that credit score in general will give you an indication, especially when you're getting that junk mail and you're opening it and seeing your credit score increase, of where your credit's trending.
Right.
And that's really important for us to know, because when you check your credit score yourself through those sites, it does not impact your score. When I check your credit, if I have to do that on a regular basis, it's going to impact your credit on a negatively generally.
Right. So you get a little ding on the score, but hopefully you get a beautiful house at the end of it.
And some pitfalls associated with your credit would be, missing payments. We talked about cell phones.
Yeah.
Pay your bills, put them on auto. The biggest thing we see is that people will go car shopping, and no flack to car dealerships, but when you go car shopping and you talk to that finance person and you're looking for, the best deal for you, you're going to end up with 4 or 5 hits to your credit bureau generally. And if you then want to go house hunting, a month or 2 later, those are going to affect your credit score. So if you are on the borderline, now you might be in a position where you actually don't qualify for a mortgage. We've seen that many times. And so that can be quite tragic, and it's a hard conversation.
Right.
So
you want to check out your credit score and maybe think twice about that brand new car if you're also shopping for a house.
Limit your credit inquiries prior to house hunting, for sure.
Got it. Okay.
Yes.
Nice. So at the end of 2020 and through to 2022 saw some pretty wild times in the market.
They did, yes.
Why is it important to include subject to financing in your offer, and when is it okay to not include that?
So I always recommend that you put a subject to financing in your offer. It is important to ensure that, the subject property has to be mortgageable.
Right.
So you might be mortgageable all day long, but if the subject property has a weird zoning, if it had previous issues or asbestos or mold or anything like that, it might not be a mortgageable property. So it's not a good idea to put yourself in that financial position.
Makes sense.
Also, we often have clients that we talk to a year prior come back and they're like, oh, I have an accepted offer a year later. And we haven't heard from them, although we've been checking in.
Right.
And in those instances, your credit can change vastly, or perhaps you've taken a leave or had an injury at work or something, and that can all affect the numbers as well.
Right.
So subject to financing is very key.
Okay.
We generally can get financing done in about 2 days. However, that depends on how current the documentation is that we have on file.
Recently, did you do your pre-qualification?
That's right.
Got it.
Yeah. So we, as brokers, we have access to lenders, and if we're doing a lot of volume with those lenders, which generally we do, which is great, we have preferred servicing with them. So we can get that application in front of the lender generally in about 2 hours.
Wow.
And then we can have the conversation about the approval and how the process is going to work. And then we can give you a better idea of what the timeline is going to look like.
Okay.
In some instances, especially conventional financing, when a client has greater than 20% down, will work, or in a market where the house values are fluctuating quite greatly, we might require an appraisal, and an appraisal can take a little bit longer.
Right.
So part of subject to financing can be that appraisal process, and unfortunately, your bank, your broker, your lender just does not control that part of the process,
Of course.
and that is a huge determining factor in how long it's going to take.
Right.
Yes.
Okay. So generally speaking, would you say like a week is safe, or you need maybe like 10 days?
So we say 10 days, and that's just in case the client's disorganized.
Right.
So in general, we'll tell people, 10 days is the norm. However,
Circumstantial.
yes, it's really nice for us to be able to say, hey, it's only going to take 5 days. One of the tragic things about saying 10 days is if we're trying to submit to a lender that has a smoking hot rate, and there is a bit of a backlog in applications, the lender will prioritize your application based on the subject removal date, which leaves the client very worried. There's a lot of stress, and it tends to be much more, well, it's just not a great process when that happens. So 10 days is lovely.
Okay.
Except in the instance that we're applying for like a particular rate or product or something that has a niche.
Okay.
Yes.
Okay. And is there ever, any time where you would say it's okay to write an offer without subject to financing?
If you have cash, you're good to go.
Okay.
We have a lot of clients in 2022 who put in cash offers, but then actually wanted a mortgage at the end of the day. They found that their investments were doing well. They didn't want to pull out of their investments. Makes sense. But at that point, if they need a mortgage and they don't qualify, I think there is a old school mentality with a lot of the baby boomer generation that, when they got a mortgage way back when, it was a handshake with the banker and the income documentation is not that important. And they have, 70% down. Why would they need a whole bunch of scrutiny placed on their income? But unfortunately, in today's world, the government wants everything to be income-based qualification. They're absolutely ridiculous when it comes to determining the amount of payment that you can afford based on their set standard of affordability.
Okay. So always include subject to financing.
Yes.
Rule number 1.
Yes.
We need about 10 days to remove that subject comfortably.
Yes.
Okay.
That's the dream.
Okay. So Mackenzie, how much of a down payment do you need when buying a personal residence, and what are some different scenarios where that down payment may vary?
So 5%
Okay.
is generally what we say.
Okay.
However, there's still a program out there where you can actually buy a house with 0% down. So it's called a borrowed down payment program.
Okay.
When you buy a house with less than 20% down, the government requires that mortgage is insured.
Okay.
That insurance is purchased through CG, Sagen, or CMHC. And that's the one everyone's commonly
knows about.
Yes, knows about, exactly. So when you buy with a borrowed down payment, that cost of insurance is very expensive. So you can borrow that down payment from a friend or a family member, or you can borrow it from a line of credit or credit card.
Okay.
Borrowing that down payment reduces the amount of mortgage you're going to qualify for. So it's not the best option. We don't even do a lot of them because the common perception out there is that you need to have a minimum of 5% down.
Right.
When you have 5% down, the government charges you a 4% fee based on the amount borrowed.
Okay.
So it's not convenient. It's not necessarily financially savvy to buy with 5% down. The best bang for your buck if you're going to buy with a minimal down payment is 10% down.
Okay.
That's where you get the best deal on mortgage insurance. If you can swing it, 20% down is the sweet spot. 20% down, there's no mortgage insurance. You get to qualify on a 30-year amortization, which lowers your payments, increases your affordability and the amount that you qualify for.
Okay.
It also reduces lender scrutiny because there's no mortgage insurer qualification that they have to abide by. So we have lots more exceptions on that 20% down.
Okay.
So
that's the magic number.
20%.
20%.
35% down gets you a really stellar mortgage rate on those insurable mortgages.
Okay.
So for example, in 2023, with our rates being so incredibly high right now, if you're looking at a 5-year fix with a bank, you're looking around 5.5%.
Okay.
And that's with 20% down.
Got it.
Okay.
5.5% with 20% down.
So no mortgage insurance or anything like that, 30-year amortization. If you are able to swing 35% down, we can get that rate down to 4.5%.
Oh, wow.
And that's a significant savings. That's 20% savings. So
That's a
it's
lot.
definitely worthwhile.
Yeah.
And if you, for whatever reason, need to borrow that additional 15%, we can lend that to you on a home equity line of credit, and you can still get the great rate on the majority of your mortgage balance. So there's some flexibility, and we can use a little creativity to help you achieve that.
Well, I'm learning so much. How about you? So we like 20%.
Yes.
What are our other options? I'm sensing there's more.
Yeah, for sure. So for those insurable mortgages, and again, insurable mortgages, you get a better interest rate on because the lender pays the mortgage insurance on your behalf. So it is insured. You are qualifying by the insurer's criteria, which is a few more hoops, mostly on the lender's side though. But if you qualify for an insurable mortgage and you have 35% down, you will get the best mortgage rates out there.
Okay.
For
the best.
Yes.
So if people are wanting to do a home renovation, what's the best way to get financing to do that?
Definitely. So if you're house hunting and you want to renovate the home that you're looking at, we can add up to 20% of the purchase price to the mortgage for home renovations. It requires a little fuss. We have to get some quotes and everything to make sure your renovations are realistic within that budget. But once the home closes, you can do the renovations, and then you'll get the money to pay back those contractors if that's what needs to happen.
Okay.
If you own a home, of course, then we can just access equity in that home, or we can do a refinance plus renovations in order to access equity based on the perceived end value once those renovations are complete.
Got it.
So adding renovations adds value.
Right.
It's definitely a good option.
Right. Okay. So there's a few options there. And then if you're buying a new home, is there a difference in how the financing works if it's a brand new home?
No, not necessarily.
Yeah.
We add the GST to the purchase price.
Okay, which is how much?
5%.
Okay.
And then that is actually mortgageable.
Okay.
So you're only actually putting down 20 or 5% of that GST as part of your down payment.
Right.
There's no kickbacks or incentives that lenders allow.
Okay.
So you have to write the appliances into the contract, the blinds into the contract.
Right.
We can't do a kickback for upgrades or anything like that.
Okay.
The lender will just take that kickback and directly reduce it off the purchase price.
Right.
So it doesn't get you that desired wad of cash that you're looking for in order to do those upgrades that you want.
Right. Okay. Thank you.
You're welcome.
Getting clear on everything. Crystal clear. So Mackenzie, please tell me, how can people find you
All right.
and employ your fabulous services?
Thanks. So in general, we use our website nowadays. Thank you, COVID. Everything is internet-based. So we generally will get clients to fill out an online application. And once we get your online application, of course, we'll contact you and we'll talk about an appointment, or we can actually just talk through your whole application on the phone. Nothing has to be face-to-face anymore, although it can be. I find that Comox Valley, being a small town, everyone likes a handshake, and I'm totally fine with that too. Yeah. But yes, so definitely. So online on our website at comoxmortgages.com.
Okay.
Or you can give the office a call at 250-331-0800.
Awesome. Well, we will also include a link to your website in the show notes. And thank you so much for your time today. This has been absolutely amazing.
It's been great.
And very educational.
Thanks.
Yeah.